Hello and welcome to this week's update. We are going to be talking about the market being in bearish mode right now. No doubt about that. If we have a look here at the opening range, we can see it's gone below 4073. We've had two consecutive days closing below the bearish opening range. So we are certainly in bearish opening range mode. This line that you see here, this prior low right there at 3858, if it closes below that level, we are officially in bear market territory. That will trigger more selling. So keep an eye on that for this week, but certainly bearish opening range mode. If we look here at the workspace, we can see that all the major indexes on Friday were down significantly. The Nasdaq was the weakest of all, down over 3.5%. Any index that's down more than 1% or up by more than 1%, but in this case, down more than 1% is a significant amount. So to be down 3.5%, that is a big deal. Now, if we look at the sectors, all of the sectors we follow are below their 21 and bearish except for energy. We've got a trade in energy still holding at the moment. We'll talk about that in just a second. Now, what has happened is the CPI number came out on Friday, and it was worse than expected. We can see inflation rose 8.6% in May, the highest since 1981. The consumer price index rose 8.6% in May from a year ago, the highest increase since December 1981. Core inflation, which always makes me laugh, the preferred number from the Federal Reserve, excludes food and energy. Even that rose 6%. Good luck living without using food or energy. Both were higher than expected, though. Okay. Now, surging food, gas, and energy prices all contributed to the gain, with fuel oil up 106.7% over the last year. Shelter costs, which comprise 33% of the CPI, rose at the fastest pace in the 12-month period, its fastest pace in 31 years. Wow. The rise in inflation meant workers lost more ground in May, with real wages declining 0.6% from April, or 3% on a 12-month basis. So people are losing money on their wages. If you take out the inflation rate compared to how much their wages went up, they lost money. This is not a good situation. So this has really spooked the markets, increased the fear, and certainly people are very fearful now that we've now increased the inflation again, because we did pull it back last month and now it's ballooned out again, even with their rate increase. The problem with their rate increase is it's totally insufficient, and it is not going to fix the problem, particularly with the rate at which they're doing it. So what's going to spark this market to move lower, Sean? Well, for me, I think it's the official declaration that we're in a recession. I think we're in one already, but the official declaration of being in a recession, which is 2 quarters, 2 3-month periods, 2 quarters of negative GDP growth. Okay, so last month they announced a 1.5% negative GDP growth. Right, the economy went backwards, didn't grow. Right, GDP is the total economic output of the entire country. So, is there a way of us being able to get an idea of what the next GDP figure will be? Well, yeah. Let me show you this. This is the Federal Reserve Bank of Atlanta GDP Now figure. Now, this is something that gives you a good estimate as to what the next GDP announcement will be, what the next figure will be. It's very accurate. I've looked at it over time. It is very accurate with a small margin of error. And what they're saying now with this Atlanta Federal Reserve GDP Now tracker is that they said a week ago that they expect GDP to increase by 1.3%. Now, a week later, they're saying actually only 0.9%. So it's actually going backwards. Again, like I said before, the first quarter growth was down 1.5%, negative. If we have another negative 3-month period, quarter, we will officially be in a recession. That will then spark the markets to really start selling off. Okay, Sean, when is the next GDP figure coming out? July the 28th. Okay, so July 28th is when we find out what this figure will be. But right now, this very accurate Atlanta Federal Reserve GDP Now tracker is telling us 0.9% increase in GDP. Then I thought to myself, is there a margin of error with this Atlanta Federal Reserve GDP Now tracker. And there is. The actual margin of error is 0.85%. They said it's going to increase 0.9%. So this could come down to just rounding as to whether we go negative or not. Will they revise this down going forward? More than likely, right? So it looks at this point as if we are headed for a recession or very close to it. And we will see. But 28th of July, mark that down on your calendars. Now, we know that this number here is very underestimated. I mean, if you just look here at trueflation.com, they're telling us it's 10.81 right now, certainly well above what the Federal Reserve has told us. But this number is heavily manipulated, right? They are straight out, this number, straight out lying to us. That's what they're doing, just straight out lying to us. Now, some of the price increases over the last year in this CPI report, just looking at their numbers, fuel oil, 106.7%, gasoline, 48.7%, gas utilities, 30.2% increase, electricity up 12%. Now, this is one that will really hurt the average family out there. Food at home up 11.9%. So we're not going out, we're staying home trying to conserve money, and even the food that we eat at home has gone up 12.9%. So this is a real problem. The average family cannot withstand these increases. Gasoline up 48.7%, gas utilities 30%, electricity 12%, and even food I eat at home's gone up almost 12%. This is a really big problem. And we know the CPI numbers manipulated because 33% of this CPI number is made up of shelter. They told us in the very latest report that shelter went up 5.5%. How on earth could shelter go up 5.5% when rental prices went up 17% and home prices went up on an average 19% for the last year? How's it up 5.5%? Makes no sense at all, unless you start to look behind the curtain as to why they would do this. Sean, why are they lying to us about this inflation number? Well, 3 reasons as far as I can see. There's probably more. Number 1, it's a political move. They want to make it look like they're doing their job well, right? They want to make sure they've got things under control. There's midterm elections coming up in the United States. They want to get re-elected, so on and so forth. Reason number 2 is the government pays around $1 trillion a year in social security benefits. Right? $1 trillion a year. In Australia, it's around $200 billion a year. Right? And these are people that are doing it tough, right? We're talking about the elderly, we're talking about survivors, war veterans, people on disabilities, and there's around 65 million Americans who rely on this money just to survive, just to get by. But of course, the government doesn't want to index these payments to the real inflation figure, which is probably around 18%. Because if they did, they would be paying a heck of a lot more than what they are right now if they index the real inflation rate with the social security payments. So the people that can afford it least are always the ones that bear the brunt of inflation going up, right? They don't really have a voice unless they unite, of course, but they typically don't have a voice, right? We don't want to go after the large multinational companies that are putting a lot of their dealing with a lot of their tax issues from overseas, trying to hide their money. We don't want to deal with them because they've got a lot of clout. They donate to a lot of our government, our political campaigns. We don't want to upset them because that could cause us problems. But the everyday person, we'll let them deal with it. And the third reason is they've got no solution. The reality is in the US, inflation is anywhere from 15 to 18%, right? But let's just say that it is 8%, right? For laughs, let's just say that it is 8%. Now, we know they're lying about that, but let's just say that it is. In order to combat that level of inflation, even at 8%, according to the Taylor rule, look it up, Taylor rule, you would need 12% interest rates to combat just this inflation rate of 8.6%, 12%. It's according to the Taylor rule, where real interest rates should be 1.5 times the inflation rate if it's above the Federal Reserve's target. Now, they're not going to increase the interest rates to 12%. Why? Because the US debt is 140% of GDP. They owe 40% more than what they make. And they're currently paying $300 billion in interest per year as it is. Now, that's with almost 0% interest. right? With almost 0% interest rates, they are paying $300 billion a year. For every 1% they increase the interest rate, the government will pay an additional $250 billion a year. So some pretty powerful reasons to lie to us about what the real number is. They know they cannot increase the real interest rate or the interest rates by more than a couple of percent before they themselves can't afford to make payments on just the interest on the debt that they have. So what's the plan? Screw the average person. That's what the plan is. It's called financial repression, my friends, where the deliberate government policy is to cause inflation, which helps the government. Sean, how does it help the government? I still don't understand this. Let me try and give you a scenario here, right? Now, this is made up scenario, but I'm trying to make it as simple as I can. So let me just use some very simple numbers here to try and help you understand this. Let's assume that the economy has 0% inflation, right? And people expect inflation to stay at zero. I know it's ridiculous, but I'm trying to educate you here, right? 0% inflation, that's what the economy has right now. People expect it to stay at zero. Now, let's assume that the government needs to borrow $2 billion. They do this by selling 30-year government bonds worth $1,000 each to you and I, the private sector. Now, to attract people to buy these bonds, the government may offer an interest rate of 2% a year. So the government will have to pay back the full amount on the bond of $1,000 plus an annual interest payment on the bonds of $20 a year, or 2%. Okay, 2% of 1,000, right? So the investors will make profit on their bond. They'll get the 2% yield back, which is above the inflation rate, which is zero, right, in this imaginary example. Plus, they get back the interest on the bond. However, what about if all of a sudden inflation increased to 10%? Well, this reduces the value of money. As prices go up because of inflation, that $1,000 that you were going to receive back for your bond now buys a lower quantity of goods and services. Now, because of inflation going up, the government, believe it or not, actually gets more tax revenue as wages and prices increase. If prices go up 10%, the government's GST, goods and services tax, or VAT in the US, VAT, their receipts increase by 10%. Therefore, inflation helps governments automatically get more tax revenue. That's right, inflation helps governments get more tax revenue. However, the poor bondholders, you and I, we lose out because the government still has to pay you back the $1,000, but because the 10% increase in inflation, it's not worth $1,000 anymore. It's only worth $900. Remember, the inflation rate was 10%. So if the inflation rate's now 10% and you're getting 2% interest on your bond, you are losing real value on your savings. You're actually losing money. Having it stolen from you is what it is. So inflation means repaying the government's debt requires a smaller percentage of total tax revenue. Remember, tax revenue increases, the real value of the debt decreases. Happy days for the government, right? They can pay back their original debt much more easily. So the government's much better off, and you and I are much worse off. It's always the way that it works, which is why I keep talking about this. And it's always the poorest, most disadvantaged, or just the everyday working man and woman that's out there doing the right thing that tends to be crushed by these type of things. And that's why I'm trying to educate people on it so they really understand what is actually going on here. So anyway, they're my thoughts. So Sean, what are we going to do here? Well, we're going to talk about getting into this now with a couple of bearish opportunities. Now, before we do that, let's talk about energy, right? Now, energy is the only sector that's up, so we're certainly on the right side of this. Let's have a look at it. So if we look at energy, there's only two things that you can do here. Close it out now or hold on. Now, you need some parameters around that. If you're going to close it out now, what would be the result? Well, if you closed it out now, position we got in last week, you'd only lose $12. Right? So $12 loss, it's okay, move on, make that up in the next trade, right? So you could close it out now, take a $12 loss and be done with it. Or what you could do is you could wait for it to pull back to the 21 and see if it gets that bounce, because it could very easily bounce off the 21 and continue to move higher from there, right? So that's definitely one thing that you could do. So you either close it out now for a small loss, probably the smart move with the markets looking to move down, or you could wait for it to close below the 21 EMA, right? Either one of those would be the way to do this, okay? Now, that's one thing you could do. So you've got to keep that in mind. Now, we know we've just gone through this where we can see that the combined put call ratio is actually bullish, right? We'll look at market internals here. The skew is neutral. The trend is neutral. The SPX put call ratio is bearish. The amount of stocks above their 50-day moving average is below 50%. So that's very bearish as well. If we go back to the charts and we looked at the stacked moving averages, we can see junk bonds are bearish, right? And actually taken out that prior low. That's very bearish development. And high yield bonds are bearish. Okay, they're certainly bearish. Goldman Sachs, so goes Goldman Sachs, so goes the market. That's certainly bearish as well. And we look here, the last one here with transports, which is bearish, right? So we've now got 7 of the 10 indicators that are bearish, plus the opening range on the SPX, which is bearish. You have to start buying some put options, right? You have to start buying some put options. It's what you have to do right now. So we've spoken about energy. Close it out now for a small loss, or wait and see if it bounces off the 21. What you could do is you could look to get into SQQQ. Now, this is a leveraged ETF. It moves about 3 times as much as what the QQQ does in percentage terms, which means you can make a lot of money on this if the QQQ, the Nasdaq, goes down. Now, if we look at the Nasdaq quickly, I'll look at the QQQ. Same thing. It's sitting right now on its 50. I think it's going to break this and move down to 260, right? The 61.8% fib level. Very weak right now. It's hit it once, twice, 3 times, 4 times. It's likely to break this and continue to move down, right? So that's what I'm seeing there. Now, if it goes down, right? So we can see on Friday, it was down in a big way. But look what the SQQ did, which is what we're going to look to make money on. It actually went up significantly. Okay, so the QQQ went down about, well, let's have a look. So 3.5%, right? And then the SQQQ went up almost 11%. Okay, so it moves the opposite. It's inverse. It moves opposite to the QQQ. So what type of option do I need to buy with this, Sean? Call options. Call. It's inverse. I don't want you to get confused here, right? So this is what you can do. Now, this obviously can make you money very quickly, obviously, right? Moves up 10%, 11% in a day. It's big money to be made there very quickly. But it can also do the same against you and move against you very quickly as well, right? So keep that in mind. This is slightly a riskier way of doing it, right? And I'll show you some less risky ways. And then you make the choice which one suits you and your trading style, your account size, and your risk profile. So you could do it like this, where you buy a call option, just simply buy a call option on the SQQQ. Bigger risk, but bigger potential profit. You could buy the in-the-money Delta 62.54 call option for the 15th of July 2022 for $7.85. Set your stop at $3.85, not too close, right? Now, your maximum risk here would be $400 a contract, 33 days until expiry. So that one's fairly straightforward. Buy the call, put your stop at $3.85, and we will discuss this next week. Now, another way you could do it on the SQQQ, which moves opposite to the Nasdaq, right? Nasdaq down, this is up. You could do it like this. You could do a call spread. This would make it less riskier than just buying the call option by itself. So, Sean, why would I always do this? Well, because if you bought the call option and it does move down, you're going to make a lot more money than you would buying the spread. That's the reason. So the potential upside here for a spread is capped. It's got a fixed limited risk when we're talking about a spread, and also a fixed limited profit. Whereas with an option, there is no potential limit on the profit. If the QQQ, the Nasdaq, keeps going down, this is going to keep going up. So this could make a lot more money. However, there's more risk, right? So here you can see we're only paying $170. We're going to sell the 60 call, buy the 55 call, both of them for the 15th of the 7th expiry, it's only going to cost $170 for one spread. Okay. Now, our break even is 56.70, not too far away from where it is right now. We could set a stop at 70 cents, so we're only risking pay 170. If it goes against us, we get 70 back, so we lose 100, right? And our potential profit is $3.30. So our potential profit is 3.3 times higher than our risk. So that's a good example of an asymmetrical trade, and that's a pretty good way of doing it, right? So that's certainly another choice. Now, the other way you could do it, if you didn't want to deal with a leveraged ETF that moves up big time but also moves down big time, right? You could just simply utilize the QQQ, right? Just simply buy a put option on the QQQ, right? So you can do it like this: buy the 292 strike put option for the 15th to the 7th expiry for $12.91. Delta 52, 33 days till expiry. Set your stop at $8.91, so you're risking $400 a contract. Now, if the QQQ does break that 50% fib level and start selling off to 260, we'll do very nicely with this put option. Very nicely, actually, right? Or if you want the least risky way of doing it of all the four that the four that I'm about to show you, I've shown you three. This is the fourth one. Out of all four of these different choices here, this is the least risky. Okay, so right now it's at 288. I'm looking for it to get down to 260. The 61.8% fib level. But if it just simply goes below 280 or moves lower for an earlier profit, we can sell the 280 put, want it to be below that, and buy the 285 put, both for the 15th to the 7th expiry, okay, 33 days until expiry, right? That'll cost you $181 a contract, okay? Potential upside, $319 a contract, okay? So we set our stop at $81. Spend $181 per contract. If we're wrong, we get 81 back, so we lose 100 for the potential to make 319. So still a 3-to-1 risk to reward, right? That's a pretty good reward, particularly now we know inflation is not under control and it's still rising, okay? So you could do, out of those four that I just showed you, call option with the SQQQ, call debit spread with the SQQQ, buying a put option with the QQQ, or buying a put debit spread with the QQQ. Out of those four, I would like you to do one, maybe two, but more than likely one of those, okay? Knowing that the QQQ is the least risky of the two, okay? So there's some ideas to be making money if the markets do start to fall now, right? And it looks to me, everything I can see, trading what I see, not what I want it to be, it looks to me as if the market is going to move down, right? Now, another trade that you could look at, and I did this by looking at the FinViz. I looked at technologies, stocks that had a return on equity under 10%, right? Not growing their earnings that well, less than inflation, and optionable, obviously, and a quick ratio under 1. In other words, they've got more debt than cash. That's not what you want to see right now. So this is bearish, looking for it to go down. And I come across NLOK. Now, NLOK, let's have a look at it here. So we've seen that big move, down almost 5.5% on Friday. Now, if we look at this with a squeeze, okay, and we can see that if we change this to an hourly chart, so we can see it's broken out of this squeeze to the downside, and it's actually forming a, if I change it to the hourly chart, it's actually forming a bear flag, right? So if we go from the top of the bear flag, which is 24.75, to the bottom of the flag, $23.25, $1.50, we'd expect that same $1.50 move to the downside, right, which is right there, okay? So I'm expecting this, based on that 1 hour bear flag, to go to 21.75. Okay. Now, also, it's got a, if we go back to the squeeze, it's actually got a 4 hour squeeze that's triggered to the downside. Sorry, that's the hour that's already triggered. We've got a 4 hour that's triggered as well. Only just started to trigger the 4 hours, so that's good. Okay. Because normally this will last 8 to 10 candles, depending on what time frame you're looking at. The 2 hour has triggered 1, 2, 3, 4, so it's only halfway through its projected move to the downside based on the squeeze. So it's got a couple of squeezes on multiple time frames, got a bear flag on the hourly chart, Okay, and if we look at the fundamentals here, look at the amount of cash compared to debt. Almost 3 times as much debt as cash. That's not a good sign. Quarterly earnings growth negative. If we have a look here at the growth rate going forward, only 8.1% per annum. That's not going to make you money in this environment. So for all those reasons, I'm looking to get into a put option on NLOK. Now, I'm going to take the 24 strike put option for the 15th of the 7th expiry, 15th of July expiry for $1.40. Okay, 33 days till expiry. I'm going to set my stop at $40 a contract and my profit taker at $3.40. So if the stock goes down as anticipated, I'll make $200 a contract on this. If it goes up, then I'll lose 100. So that's a 2-to-1 risk to reward, asymmetrical opportunity in my favor. Okay, so that's another position that you could think about doing as well. Okay, so you've got a couple of different choices there. SQQ or the QQQ. I don't recommend you doing all of them, just picking one of them, whichever appeals to you the most and whichever one you can accept the risk on, and going ahead and placing the trades from there. All right, my friends, it is monthly option expiration at the end of this week. We'll be talking about all of our positions in the next weekly update. Hope you enjoyed that, learned something from it, put a bit of time into that for you guys, and I will talk to you all again next week. All the best, and bye for now.